Statistics show that 90% of retail investors lose money because they prioritize short-term speculation over compound interest. If your portfolio is more than 20% in cash right now, you aren't playing it safe. You are experiencing a silent capital erosion of your purchasing power every single second. In this video, we aren't talking about get-rich-quick schemes. We are diving into market analysis, dividend investing, and tax optimization. I'm going to show you the exact blueprint I used to reach financial freedom at 34, managing a high-performance real estate portfolio. No fluff, just the math. Most people tell you that a $100 crypto moonshot will change your life. That's not a strategy, it's financial suicide. At 25, I was that guy. I failed at dropshipping because my ego was bigger than my spreadsheet. I thought hustle was enough. It wasn't. Real wealth follows a hierarchy. If you don't know where you sit on the capital ladder, you're just gambling with your future. If you have between $100 and $1,000, stop looking at the S&P 500. A 10% return on $1,000 is $100. It won't change your life. At this level, you are the asset. When I worked as a waiter in a high-end luxury restaurant, I watched the truly wealthy. They didn't argue over the price of the wine. They argued over a $50 error on the bill. Why? Respect for the math. I took my tips and invested in myself, technical certifications and learning how the insiders operated. In the age of AI, a niche skill like specialized AutoCAD design or high-level project management provides a return on investment higher than any stock. Your first goal is to increase your earning power so you have dry powder to invest later. Before you build a skyscraper, you dig a foundation. Most people fail because of loss aversion. They invest their rent money, the market dips 5%, they panic and sell at a loss. This is why you need a sleep fund, $1,000 to $10,000 in a high-yield liquid account. Once your firewall is up, we move to automation. Between $10,000 and $50,000, your job is to be boring. You want low-cost ETFs. Let the market volatility work for you, not against you. This is the asset allocation phase where you build the habit of a practitioner, not a spectator. Once you cross the $50,000 threshold, diversification becomes a trap for the mediocre. As the saying goes, wide diversification is only required when investors do not understand what they are doing. That was Warren Buffett in his 1993 letter to shareholders. He knew that to build massive wealth, you need concentration. I reached my tipping point at 29. I found a ruined house in a bad neighborhood. I didn't have the cash, so I used OPM, other people's money. I called an investor I met during my waiter days. I told him, you provide the capital, I provide the sweat and the strategy. We split the profit 50-50. We flipped it in 4 months. That was my first big win. From there, I stopped buying everything and focused only on real estate and my own systems. Focus builds wealth. Diversification protects it. You will lose if you fall for analysis paralysis. Waiting for the perfect market entry is a fool's errand. You will also lose because of the sunk cost fallacy. I stayed in a failing business for 2 years just because I put so much work into it. A CEO doesn't care about past effort. A CEO cares about future yield. If the data says the ship is sinking, you don't keep bailing water, you get off the ship. Be transparent with yourself. Are you holding an asset because it's good or because you're afraid to admit you were wrong? Financial freedom isn't a lottery ticket, it's an engineering project. If you have $100 today, close the brokerage app and buy a book or a course that teaches you a high-value skill. Start there. I'm sharing these notes from my journey because I want you to reach at 30 what took me until 39. If you found value in this strategic breakdown, please gently hit the like button. It helps the algorithm find more practitioners like us. Success is a math problem. Start solving it. I'll see you in the next analysis.